Good morning, folks. Welcome to the next edition of the weekly wrap. So last week I was not well. I had such a bad sore throat that I could hardly speak, and I missed recording the weekly wrap. And happy to be back here today. So we're going to cover these 5-6 points today for you all. We start with the precious metals. Of course, it's been hogging the limelight, so to say. And then something on how inheritance rules can vary for children. Okay, we generally think it doesn't, but then there is a variance. Then another interesting topic: does a high active share in a equity mutual fund necessarily mean outperformance? Let's look into some of the research that's been happening there. Then something on money habits, and a take on capex, and if time permits, on the rupee depreciation. Okay, so let's dive into it. There's been a huge rally almost on a day-to-day basis. Gold and silver have been shooting up. It's almost like it's like a fad. I think it's beyond fundamentals. The rate at which it's not the rate at which the prices are moving up, the rate at which people are crazily going ahead to put their money into gold and silver, selling other things and buying gold and silver. So this is where I think it's a huge FOMO trade. Okay, gold has been going up since 2019. Okay, but it's only now, after seeing 20-30% increases every year, that people feel they've lost out and they want to buy. And this is where one has to be really careful. Okay, because you're not buying for fundamentals, you're not buying for diversification, you're not buying for portfolio balancing. You're buying because you feel that you missed out on a rally. And that is where mistakes tend to happen. Both gold and silver are rallying. Silver is rallying more sharply. And in fact, the last 1 week has been rather unusual for silver ETFs, because what has been happening is the price of the ETF in the market has been quoting way above the net asset value, or way above the price of silver. So it's a premium that is running there. And yesterday the premiums were almost 5-6% or more, and in general about a 10% premium to the price of silver is what ETFs are being priced at. So if you're buying into a silver ETF now, you're actually paying a premium of 7-10%. That is not right. I mean, why should you be doing it? But it went rather unnoticed, and yesterday it sort of came into the open. So one has to be wary, and if possible, put it off. Don't buy it now. Wait till the premium comes off, and then you can buy the silver ETF. Okay, if you have to. If you ask me, one should not be buying into this kind of a trade where every other person is looking to jump into the gold and silver rally. This is a time probably where you have to let go a bit, maybe sell off some of your existing holdings, book profits, sit by the side and see what happens. It's the most difficult thing to do, but possibly that is the best thing to be doing as of now. And of course, and the one of the things that has been going in favor of silver all these days is that, one, there's an industrial demand for silver, and two, there's a short supply of silver. What do you mean by short supply? The demand on an annual basis is more than what is being mined from the silver mines. Okay. Maybe silver mines is a wrong thing to say, because silver is always a byproduct of something else like zinc or copper, gold. Okay, but then what is being mined out is not sufficient to supply the annual demand. It used to be about 200 million ounces a year as a shortfall, and that was touted as a reason to be buying into silver. But over the last 3 years, the shortfall has actually been reducing. As more and more silver gets mined out, it's keeping pace with the additional demand. And what was about 200 odd million tons, million ounces of silver shortfall is now about 118 million ounces or so of shortfall. Okay, and this over time will, of course, I think, normalize. Until then, where is the silver coming from? The silver is coming from the already mined inventories that the exchanges and the investors have. That has been the equalizer. So that is one thing. The gold-silver ratio was another thing. Gold had moved up so much and silver had not moved up as much. So the ratio of gold to silver, which many analysts track, seemed to be skewed. Okay, it had gone up as high as 85 times. Gold was 85 times as expensive as silver. And an average has been 60-61 times. So it seemed to say that there is scope for silver to move up, which even I would think. But this kind of mad rush makes me change my mind and say, whatever be the ratio, I don't think one should be looking into buying into a fad like this, into a FOMO trade like this. Okay. So that gold has also been moving up, and there has been some interesting analysis that I've been seeing on how to value gold and silver. On silver, yes, the gold-silver ratio is the only thing that is going for it apart from demand supply. As far as gold is concerned, the theory is that if gold is a replacement for money, then all the gold that is mined and is above the ground should be equal in value to the money supply, the entire money that is there in the world, which is a M2 of US and M2 of Eurozone, the two large economic zones. Okay, so the calculation seemed to say if you take the M2 of US and then half the M2 of the Eurozone, half because you don't want to be double counting. The euro already holds US dollar, it also holds gold. So instead of double counting, half the Eurozone's M2. If you take both these and put together and see where are we seem to be somewhere at a midpoint in the valuation, and which says that maybe $3,800 an ounce of gold is somewhere the midpoint of this, and we are already there. We are close to almost $3,900 to $4,000 an ounce. So there doesn't seem to be much scope based on this valuation model, and believe me, there are not many valuation models for gold, because gold, as you know, doesn't pay interest, doesn't earn profits, there's no cash flow coming out of it. It's only a demand supply situation which creates, so it's very difficult to model a value for gold. But the one that came closest to having some logic was equating the value of the 216,000 tons of gold that is above ground to the entire money supply that is there. Okay, and we are almost valued. So I would be rather careful. The other thing that has been happening is the investors in the western part of the world, that is US and Euro, have only now been paying attention to gold in the retail fashion, and there's a larger flow into gold ETFs in the western world, whereas the Asian world had already been investing over the last few months into these ETFs. So that is also possibly driving the trade. One short-term driver was the US government shutdown. So when the borrowing limits, the spending limits of the US government are not approved by the House, then the government shuts down. It seems funny, but it keeps happening. It's happened more than 30 times in the past that the US government shuts down and there's no money to spend on non-essential services. So that somehow seemed to be a trigger for gold price to move up. In my view, it's not a sufficient trigger for gold price to move up, but given the kind of momentum gold was facing, any trigger would have worked, and this trigger worked. It does mean that when the shutdown ends, the gold should fall. The shutdown will end. There will be an agreement between the Democrats and the Republicans on what to do about it, and the US government will function again normally. So if you think that the gold price should fall, then why should you be buying now? Okay, so it doesn't make logical sense. So many investors seem to have forgotten that both gold and silver have undergone significant price corrections in the past and significant time corrections. Okay, so even as recent as 2012, gold and silver crashed. Okay, and it took almost 6 years in India for the price to be regained as far as gold is concerned, and silver took much longer for the price to regain. It has also happened in the past in 1996 and 2004. So let us not forget that gold and silver can undergo price corrections. There can be very long periods where they don't do anything. Okay, and investors should remember that before piling into these precious metals. Okay, that is one thing. And yes, the premium on silver ETFs today, because of the short supply of physical silver in the Indian market, is causing it. Please be wary. Allow that premium to wind down before you start buying, if you have to buy at all. Okay. Then the E.T. Wealth has an interesting article here on inheritance rights for children, and the headline says, "All kids are not equal." Funny, right? But actually, come to think of it, there can be different kinds of kids. What are the different kinds of kids? Kids of divorced parents, adopted kids, kids of live-in couples, children born out of wedlock, stepchildren. So there you have so many types of kids. Okay, and yes, the inheritance rules do vary for each of these categories, and not only the category wise. The Hindu Act says one thing, okay, and the others say other things. So there is a huge difference, and one should be careful if you're planning out your succession as to how to work if you have non-biological children born out of wedlock, etc. Okay, so in the case of children of divorced parents, there is no change. Biological children, kids of divorced parents, there is no change from the norm. That remains the same. Okay, and as when it comes to adopted kids, okay, in the Hindu law, adopted kids have the same inheritance rights as biological kids. Okay, and are entitled to a share in their adoptive parents' property if they pass away intestate. Okay. However, according to the Hindu Adoptions and Maintenance Act 1956, the adopted child loses the right to his or her biological parents' property or to the associated co-parcenary property, meaning biological parents can voluntarily leave property or other assets to the adopted child through a valid testamentary document such as a will. Okay. In the case of Muslims, adopted children do not inherit from the adoptive family unless willed up to 1/3 of the estate, unless it is mentioned in the will. Okay, such children inherit from their biological parents, but in case of the adoptive parents, it has to be in the will. In the case of Christians and Parsis, it is similar to what is for the Hindus. Children born out of wedlock. Okay, so there are court cases to state that children from void or voidable marriages are considered legitimate under Section 16 of the Hindu Marriage Act, okay, 1955, and are entitled to inherit property from their parents. Okay, so in the case of Hindus, such children are only entitled to the property of their parents and not of any other relation, that is ancestral property in this case. Okay, and though there are, I believe, Supreme Court cases which state that children born out of wedlock have a right to their father's self-acquired property as well as ancestral property. So that's a bit of a debate. In the case of Muslims, okay, the child inherits only from the mother and her relatives, not from the father, unless the paternity is acknowledged. Okay, then so inheritance through a will or gift from father is possible up to 1/3 of the estate in the case of Muslims. Okay. In the case of Christians and Parsis, Christian kids have full rights in the mother's property, and if paternity is established, also in the father's estate as per the recent court trends, as says the article. And among Parsis, legitimacy was traditionally strictly enforced. However, now if paternity is established, such kids may have rights in the father's estate and automatic rights in the mother's estate also. Okay, kids of live-in couples are largely treated the same as kids born out of wedlock. Okay, but in the case of Muslims, such children are considered illegitimate and can inherit only from the mother and not the father unless the paternity is acknowledged. Okay, so these are the different kinds of rules. In the case of stepchildren, unless the stepchildren are adopted through the adoption process, they will not have the equal rights. Okay, so it says none of the religions has an automatic inheritance right from the step parent unless the stepchild is legally adopted or named in a will by such a parent. Okay, so of course, whenever the parent goes away intestate, that is without writing a will, these acts. But if you write a will, the will holds whatever it is. Okay, so well, if as these different situations become more frequent, I think people would have to be conscious of what kind of inheritance rights devolve. Okay, then the last E.T. Wealth also had some very interesting research, I must say, on whether active shares in equity mutual funds do result in outperformance. So what is an active share? You have a index like say the Nifty 50, and then you have an equity fund manager who's following large cap stocks as an investing style. So he can either have weightages similar to the index or vary a bit from there. If he actually goes as per the index, it's as good as an index fund. No point. You can't call it active. But if he wants to call it an actively managed mutual fund, then you would have deviations from the index. For example, if a stock holds 10% in the index, the fund manager may choose to have less than 10 or more than 10% in that particular stock in his fund. Okay, the deviation is called the active share. So suppose there's 10% of Reliance in the index, for example, and the fund manager chooses to have 15% in his fund, then there's an active share of 50% for that stock, that is 5% more than what the index holds. So an active share happens when the fund manager has a particular view on that stock or that business and thinks that it makes sense to have more or less of that stock in his portfolio. So when you come across an equity fund with a large active share, that means the manager does believe that being very different from the index is going to help deliver superior returns. Has it actually resulted in superior returns? That was the research conducted, and the results are a little astonishing. Okay, so it does say in the case of large cap funds where it was compared with the Nifty 100 TRI index. Okay, you had active shares ranging from 32% to 57%, almost 58% almost. This was the extent of active shares in the large cap funds, okay, that were taken with at least a 6-year track record. So did it happen that the funds with the largest active share deliver outperformance? No. The funds with the largest active share outperformed the index only 1/3 the time, 33% of the time. And another one with a 50% active share outperformed only 49% of the time. And strangely, ones with a lower active share also outperformed at a higher rate. Okay, so you had for example, the Can Robeco large cap fund, which has a 33.5% active share, outperformed 78.9% of the time. Whereas the Franklin India large cap, which has a 55% active share, outperformed only 33% of the time. So it doesn't necessarily mean that an active share results in outperformance. Okay, and in the case of mid cap funds, also the active share did not necessarily point to a trend in outperformance. In fact, there's a large underperformance of the index. In any case, we saw that mid and small cap funds were underperforming the index, if you've been hearing my earlier podcasts. Okay, and the active share did not help. Whereas there may be one or two outlier cases where the active share helped, like in the case of the Nippon India Growth Mid Cap Fund, had an active share of 58% and it outperformed 90% of the time. Okay, so these are outliers, I would say. And in the case of the Nippon India Small Cap Fund, has an active share of 73% and outperformed 100% of the times on 3-year rolling return basis. Okay, so I would think that it is not the active share that one should be looking at closely. It should really go back to seeing what is the skill of the fund manager. That can, that is a better way to look at it than the active share. Even those who have not had active shares, large active shares, have managed to outperform only because of the discipline in execution, in timing, in sizing. Okay, so that seems to be the better thing to focus on and measure when you're looking at active shares. The last week when I missed my wrap, there was a Mint conference that was happening in Bangalore, and you had some of the leading lights of the investment world gathering. Okay, and they're speaking. There's one particular page that I found interesting. It says Money Unmasked, Pro Tips and Guilty Pleasures. So it was like, I guess, something like a rapid fire that happened, and these investment gurus were asked questions, okay, and they had to answer. So some very interesting stuff I saw, okay. So the contradictions. So one of the questions asked was, which is a financial habit you would swear by? Okay. And one gentleman said, systematic investment plans. Okay, great. The next question, one financial rule you preach in public but ignore in private. The gentleman says, continue and stay put in SIPs, in systematic investment plan. Though it is a habit that he swears by, in his personal discipline, he was not able to keep up to it. Okay, these are not lay investors. These are seasoned investment gurus and who head mutual funds and head wealth management companies, etc., etc. Okay, and another wealth manager says the one financial rule you preach in public but ignore in private is investing systematically. So the thing is about SIPs and investing systematically, you need a lot of discipline and you need to be unemotional. Okay, and the most seasoned of investors find this the most difficult thing to do for themselves. While they may enforce it for others, for themselves, all kinds of emotions come in play and prevent them from following these simple rules of investing. Which is why I think it is required to have an investment coach, an investment advisor for everybody, because then that advisor can hold a stick and enforce the discipline in an unemotional manner, and that is what works. So I think even investment gurus should have an investment advisor. Okay, what about me? Yes, I have an investment advisor. I don't manage my investments myself. My team manages it for me. So I'm keeping emotions away. Okay, I think that is what has to happen. That is human. One cannot help these things. Okay. Couple of other interesting, the most ridiculous advice that you got, and gentlemen, says looking at insurance as investment. Okay, and similarly, the silliest thing that you bought and justified it as an investment, as a guru says, buy insurance to get tax rebate. So these misconceptions on insurance are very, very strong, and the reason why these people are mentioned, because many people think insurance is an investment. Insurance is meant purely for protection, and you should diverse the two. The investment part should be done with mutual funds. The protection part can happen with insurance, and don't mix them up into ULIPs. Okay, so that is one part of it. And then as we go into the business standard, okay, so we have in the editorial article called The Elusive Private Capex Boom, written by Debashish Basu. And Debashish Basu always plays the devil's advocate. He always has a counter view. Okay, and you should just take your political biases to the side and look at the logic of his counter view. I like to do that, and whether I agree with him or not, I do take into consideration his view. So he says we all think that the the capex boom, which is not happening, or because of supply issues, but actually what he says is the earlier times when we had capex booms, the economic conditions then were vastly different from the economic conditions today. So at those points of time when we had this capex boom in India, global economy was booming. Asian savings were flowing into investments. Okay, the kind of prosperity that the Asian tigers had in their kitty, that was going into investments and funding growth across the world. So you had China roaring, you had global trade roaring, you had Asian savings getting channeled into investments, and all of this was conducive to a capex boom. But today we don't have a booming global trade. We are struggling to have a reasonable growth year on year. And if it weren't for emerging markets, the developed world by itself would hardly notch up global growth of more than 1% or so. Okay, so that is one part of it, that the economic conditions are different. Second, seems to see that it is not the supply side, but it is actually the demand side. The demand side is not good enough, because of which new production capacities are not happening. So the government needs to be looking to set right the demand side of the equation and the supply side of the equation, which it seems to be focusing on. And I tend to agree with him. Going by all indicators, we need to do something to set right demand. Okay. And then we need to look at what's happening to the rupee. The rupee has been happily depreciating through and through. So Madan Sabnabis in the Mint writes that the rupee's new depths against the US dollar. What's going on? So you have the dollar weakening. So if the dollar is weakening, the rupee should have appreciated, right? No, the dollar weakened, the rupee weakened, also weakened. Okay, that means inherently there have been some issues with the rupee that caused it to weaken. Okay, and while our current account deficits are fine, they're all under control, we don't have an issue there. We have large forex reserves of $700 billion. That is not the issue. What is the issue? Why is the rupee depreciating? One, demand supply. We have seen large FPI withdrawals of the order of 2 lakh crores and odd going out, and not enough coming back in. FDI, the net FDI has been very low because a number of private equity companies and promoters have been liquidating their holdings in India and repatriating it out. So we are having net FDI also at very low numbers. And then the weak sentiment about the Trump tariffs, which all of you know, the 50% tariff on India has really brought sentiment down. So these are the issues that are really impacting the rupee weakening. And the Reserve Bank has not really been intervening to support the rupee, which is actually in a way good, I think. Let the rupee find its place in a natural manner. Let the market determine the value of the rupee. Because the central bank, how much ever it spends, the moment it finishes spending, the market will again push the currency back to where it was. So it's no point spending that many millions or billions of dollars trying to support the currency. And actually, if you look at it, we are saying that tariffs have rendered our exports uncompetitive. Okay. One way to correct that is to depreciate your currency. So if not all of it, to some extent at least, we can become more competitive and offset some of the tariff increase by a currency depreciation. Okay. So this is what is going on about the INR weakness. Don't always think it's bad. Remember that it can help us overcome and offset some of the tariff impact that we have been seeing. So that's all for this week, folks. Have a good weekend. Bye.